Hi there, I'm Dan Ferris. I'm the editor of Extreme Value, a value investing newsletter published by Stansberry Research. And you can find more about that at stansberryresearch.com. And if you already know you like the newsletter, you can always go to extremevalueoffer.com. Today's video is inspired by a meeting that I had in Vancouver recently that I just wanted to tell my readers and other folks about. So let's talk about that. Um, I met with one of the best investors that I've ever met in about 20 years of doing this, and I just wanted to tell you a few of the things that he told me that really impressed me, that I thought might be potentially valuable to folks managing their own money. I'm not going to tell you his name. I'm going to keep him anonymous. I did name him in one of the issues of our newsletter, Extreme Value, within the past couple of months here, as of July 2018, but I'll just kind of leave it at that. And I think he'd rather stay a little bit anonymous. I know people outside the newsletter audience see these videos, so. This fellow manages, I think they manage a couple $100 million or something, or maybe $100 million. And they are deep value investors. Excuse me. And there are a few things about their portfolio I thought you might find really interesting. The first thing is the level of concentration. They have 7 positions. 7. And he looked at me and he said, I won't even consider an idea unless I'm willing to put 10% of my money into it. And I want you to think about that. It's a huge commitment. And when you decide to make a huge commitment like that, other things kind of follow from there. And you make those huge commitments and you get them wrong, it costs you a lot. But if you get them right, you make a lot. And that leads me to the second thing I wanted to tell you, which is they're obviously very selective, okay? They're highly selective. They're the pickiest investors in the world. They look at 1 or 2 ideas a year and they research them for 6 months. Now, we do that sometimes in Extreme Value, but it's kind of rare. Mostly we put a month or maybe 2 into an idea before we pull the trigger or not. And I think that's pretty good. We put out an idea almost every month, most years, and putting a couple of months into something before you kind of commit to it is reasonable to me. But think about a guy who won't buy something that unless he's willing to put 10% of his money into it. He only looks at 1 or 2 ideas a year, and he researches them deeply over a 6-month time frame. That leads me to the next thing that I want to tell you. And that is, he told me about this one idea that they had, and I won't tell you what it is because we actually have it in our newsletter now. And he said, well, a couple years ago when we found this thing, or a year and a half or whatever it was, he said, I wanted to put 25% of the fund into it, but I could only get 20% into it. And by doing that, they doubled. They did that late in the year. I think it was September, October, a year and a half ago or something. And they wound up doubling their fund by the end of the year. And he told me, he sat in front of me, this guy who was one of the greatest investors I've ever met, one of the smartest and most down-to-earth people. And he said, Dan, I've been doing this for a long time, and he's been managing money his entire career for decades. And I really think there's one thing that I've found that all the best money managers do. They all do this one thing, and we do it too, and it's made all the difference in my personal fortune and in my, clients, the results that I get for myself and my clients. And of course, we're having lunch, and I'm just like leaning forward, saying, "Yes, yes, yes. What is it?" And he said, it's just the ability to spot. I'm going to interpret what he told me, but it amounted to the ability to spot the fattest pitch and the willingness to commit a huge slug of capital. And that example I gave you just a minute ago was one of them. He said, we found this thing. It was completely beat up. It was as cheap as anything he's ever seen in his life. The industry was at multi-decade lows. They were able to buy assets for pennies on the dollar. Cash generating profitable, assets, and they went for it and put 20% of the fund in it and doubled their entire fund over the course of, I think, 4 months or something, and made even more return after that. And I thought, wow, that's something. That's it hints a little bit at talk that you've heard from Warren Buffett, doesn't it? Because he says, you should really just know things very, very well. You should know things that you invest in so well that if the stock exchange closed for 10 years, you wouldn't care. It wouldn't mean anything to you. And that's what this guy does. They don't really care about the volatility. And I can tell you, we actually have 3 positions in common. I didn't know about the other ones when he told me about this one idea that we now share. It turns out we have another. I took 2 of his positions, and it was kind of one idea, and then we did our own work on that and put it in the newsletter, and then found out in conversation, well, we have this whole other thing that we had done in common, and then another one from that. So we have all these things in common, and I guess what I'm getting at is that I've met an investor who this was somebody I didn't know at the beginning of this year. And it turns out that, kind of all the things that we've been trying to do in extreme value, this guy's been doing for his clients for years and years. And it's kind of neat to just sort of meet a kindred soul and find out what they're doing and have him tell you, we really think you should know a whole lot about the businesses you invest in, and we think you should have very few ideas, 1 or 2 a year, if that, and we think you should be ready to commit a lot of money to them, and we think they should be, only your very best ideas. And then on top of that, he named times like when he put 20% into that one situation, and he said, and on top of all of the other stuff, you got to be ready to kind of go for it at those moments when you recognize opportunity. Even though you've already gotten interested, you're already willing to commit 10%, you already know you like the stock, you already know you've done enough work on it, and then some event happens that makes it even more appealing. And your ability to recognize that and commit the capital to it. And other guys around Stansbury have written about this. A guy named Brian Hunt, who I haven't heard from in a while, he used to write about being a pig, is what Stanley Druckenmiller calls it. And Stanley Druckenmiller, of course, is a very famous trader, worked for George Soros. He was really the guy who was shorting the British pound. And you can blow yourself up being a pig if you don't really understand it. If you don't understand that being a pig and committing the capital to a huge position and knowing something very well, it's based on deep knowledge of the position and the investment. It's not based on your willingness to go for the jugular and just take a big risk. In fact, it's based on the idea that you have de-risked the position. You have de-risked the idea by understanding it deeply enough and understanding the potential volatility of it and what's likely to happen and how cheap you're getting it and what you're getting for that price. It is a very deep business-like relationship with the investment that allows you to, as Stan and Brian Hunt and myself would put it, be a pig. and take a large position, as this other fellow that I'm telling you about did and does regularly. You know, whenever they commit money, really, 10% position is big. So I wanted to tell you about that because it's good to find kindred souls in the world who invest like you do and who are doing what you'd really like to do all the time. Not everything we do in extreme value is like that. And frankly, our maximum recommended position size is 5%. It's not 10%. And their minimum is 10% that this guy's talking about. So you know, it's not completely the same, but you know, there are stocks that there's stuff that we're holding in extreme value that I don't think I'll ever recommend selling it. I'm not able to hold it myself. That's how we run things at Stansberry Research. It's pure research. I'm not allowed to buy this. I'm contractually forbidden to buy the stocks that I recommend, okay? But man, if I weren't, I'd be pouring money into some of our ideas, and I think my readers know exactly which ones those are because I've told them. There are two of them in particular. And so that's the idea for today, is just think about what kind of investor you are, and my kind of investing is deep research, those rare fat pitches, and being willing to commit to them, and knowing them, you know, having the experience and the deep knowledge and everything to understand when you're looking at one of them and taking advantage of them. Might not be for you. It's not for everybody. Some people like to stay diversified, and in their equity portfolio they take a lot of small positions and they cut losses quickly, and I think that works for a lot of people. You know, we sort of bridge the gap between that and this huge position size, you know, one idea per year kind of stuff, and we tell our readers kind of which is which. But I think there's a place for that idea in a really thoughtful, value-oriented investor's portfolio, and that's some of what we do in extreme value. So if that appeals to you, and you understand that we don't do refunds, you might want to go to extremevalueoffer.com and give us a chance to, you know, spend a year with us and see if the ideas make sense to you, if what I'm describing appeals to you. So that's about it's about as heavy a sales pitch as I think you're going to get from me. So that's all for today, and I'll talk to you guys again real soon, hopefully. Bye.